Hi, I'm Ashley Swartz. Welcome to our 12-part series on building the Adaptable Media Enterprise. I'm the founder of Furious Corp, and we're going to be co-publishing this with our friends at Beat TV. We're very excited. We're going to start by deconstructing the industry, as we said, using some sort of frameworks from other industries. And we're going to then reconstruct it and talk about how we move forward as an industry. Our focus is really going to be on television and the business of video sort of as media. And our first segment is going to be about the business of television and video, most importantly, right? So let's talk about the economics of it, specifically this construct of old media versus new media, right? And the way we kind of differentiate that, and we'll use this thematic throughout the series, is old media is really about sort of like fixed costs, right? It's the cost of distribution and infrastructure, the old business models of television and distribution. New media is really the business of audience, right? Pure digital publishing or distribution, where really the greatest investment is about building and retaining an audience and sort of continuing to renew that business cycle, right? And what does that mean, right? Ultimately, what we've seen is that digital businesses struggle with sustainability, if you will, and ultimately a lot of them don't have the runway to be able to determine whether or not they can build a long-term sustainable, profitable business. And we're going to talk about maybe why that is overall. New media is chasing its tail, perhaps, right? That's something we've said over and over again. So let's dive in a little bit. So traditional television and video, right? I mean, we look at operators and broadcasters. So what is their business? They really have a business of fixed costs, if you will, right? There were substantial economic barriers to entry because of the upfront investment required in infrastructure, right? So whether it's, distribution for broadcasters or it's the physical cable that cable operators have actually laid. And it was also controlled, right? There were licenses that needed to be purchased, whether it's for over-the-air broadcast or distribution. That has a large economic investment. And ultimately, it controls a marketplace where there are limited numbers. There really just were 3 over-the-air guys in the beginning, right? You had very little choice in the living room at one point in time. And then what we see is that once those costs are amortized from a traditional accounting perspective, right, or depreciated over 10 years as a capital investment, all that stuff goes to the bottom line, right? So what you end up seeing for old media, which is this fixed cost infrastructure, is that they really end up with this steady state business model of like a 50% gross margin and maybe a 20% net margin. And so this long-term business is really attractive. And so these guys are, big. They have lots of shareholders and lots of free cash flow, right? One of their business challenges is that they have that profit and they need to invest, and they always have choices. They can issue a dividend. They could use that free cash flow to, buy other companies, which is maybe one of the reasons we see a lot of consolidation and some shopping sprees of some of the big media companies in our industry. Or ultimately, they can just sort of let it sit there on their balance sheet, which isn't necessarily a good decision either, right? The business of digital is a little bit different, right? Digital is sort of a business model of variable costs because not only is the cost of distribution for digital incremental, it may get a little bit cheaper because you can, sort of distribute the costs of servers and things like that. That reduces as you get larger from economies of scale, but ultimately every additional sort of petabyte or terabyte of video or whatever that you serve costs incrementally more, right? And ultimately what's up happening is you are paying to build an audience, and audiences are of finite number, right? So you could invest to acquire them, and then you invest to actually retain them, right? So what happens is that the incremental cost of service is very expensive for digital. And if we fundamentally look at digital businesses, what I continue to struggle with is finding a digital business that has a long tail sustainable business model that is profitable, most importantly. Because really often the realization of economic value for digital companies is in the acquisition of by large media companies, right? And that sort of is encouraged or very much so influenced by the investment cycle, right? So venture capital, this construct of unicorns, right? What we do is we basically invest in companies for the purpose of an exit, a 3 to 5 year exit at a 10 to 20x multiple. That's not necessarily going to build the same businesses, or the output of that process is not going to be the same business that is profitable over a 10 to 20 year business horizon or more, as many of the large media companies are 50 plus years now that we know, right? So what does that mean? Well, I think one of the things that I've been struggling with is that, the ultimate sort of funny part is digital companies have sort of three choices. Either they ultimately become profitable in order to be able to fund their growth because they have to invest in growth. The investment has to come from somewhere. They continue to raise capital at astronomical valuations, which we see the market is sort of starting to say no to that and the bubble is going to burst. Or ultimately they exit or get acquired, right? Which is interesting because that's exactly what's happening because these large companies need to invest their cash flow somewhere, right? So that's what happens. They are aligned with fixed assets or fixed infrastructure or technology or some type of tangible asset, and that's really the place at which they realize their return is through the complement to a more traditional old school business. I think one of the things that I get, I'm so intrigued by is that some of these successful digital publishers like Vice and Red Bull, et cetera, they've actually found a success pattern by re-engineering or reverse engineering and going into old media. Vice is in the television business. Red Bull's trying to launch a television channel and over-the-top solution as well, right? So all roads go back to traditional media as the business model that really delivers shareholder return or sort of creates economic value. And so I think that exploration is foundational to what we're going to explore over the next 11 series, or 11 episodes in the series, rather. This is a conversation. It is meant to be sort of, something that stimulates betterment of our industry, right? There's many challenges right now, but there's opportunity and room for all of us. And this is about moving our industry forward with a sea change, not just a step change of incremental improvements. So we welcome you to be part of it. See you in episode 2. Thanks.